at the macro or bigger level, there's really two investing extremes. Buy and hold on one end and active trading on the other. And you can have a little bit of mixture between the two, but in the end, you're looking at buy and hold versus active trading. Because with both of those ends of the spectrum, so to speak, you can then invest in different stocks from different market caps, or use different strategies such as investing in growth stocks or value stocks, or using something more exotic like dogs of the Dow or something of that nature that we're going to learn about, or just tracking an index or buying individual stocks or mutual funds. All these things are part of this. So those are the individual strategies. We'll look at the actual tactics. But in the end, you got the two extremes. Do I buy these vehicles? Do I buy these individual stocks or mutual funds? Or do I implement the strategy around buying low, undervalued stocks as a value investor? Or am I buying growth stocks or whatever it might be? But once I buy them, do I hold them for a long period of time, which is buy and hold? Or do I buy and maybe be more active in trading and switching those out? And that's what we're going to look at here in this lesson, is looking at buy and hold versus active trading. And then the future lessons, we're going to then see how we can then implement different strategies and tactics, but we still might, as an investor, be more of one side or the other, maybe a mixture, but usually you're one side or the other for the most part. As far as a philosophy that you have from investing in these investing streams. So let's look at buy and hold and active trading. So first off, buy and hold. What are the advantages of buying and holding, and what do we mean by buy and hold? Well, first off, buy and hold means you're buying something and holding it for long periods of time, right? You might be holding a stock for 20 years. You might be holding it for a couple of years. It's not something that you're turning over in less than a year typically. Something you're going to hold for at least a year, maybe 2, 3. And the idea is you really want to hold it maybe for 4, 5 to 10 or longer. You want to hold it to give it time to, if it does go down, to recover and maybe pay a dividend or things along the way. But you're really buying and not incurring lots of extra transaction costs or anything. You're buying that stock with the idea that you're going to hold that stock for a long period of time. So the advantages of buy and hold is, one, it's easier to manage. You're not constantly buying and selling stocks. You buy it, you hold it, you put it off the side, maybe you buy another one down the road, or you buy a mutual fund, whatever it might be, and you're letting it ride, so to speak. So you're easier to manage that. You have great reduced transaction fees, because every time you buy something and sell something, particularly individual stock, every time you buy an individual stock and sell an individual stock, there's a cost, there's a trading cost or a fee that's associated with that. So the more active trading you do, more buying and selling of stocks, the more fees that you're accruing each time along the way. If you buy it and hold it, well, heck, then you have really reduced those transaction fees really, really dramatically. Better tax efficiency too, because every time you buy something and then sell it, whatever you have for a gain is then taxed. Your gains are taxed. So by buying something and holding it, let it gain over a long period of time, it might be more tax efficient for you to then sell later on. A lot of people use a strategy like, I'll buy now and then I'll hold it till I'm maybe in retirement, where my income is lower and my tax bracket is lower, and thus I'll be more efficient when I do eventually sell them. But until that time, they're basically growing tax-free, and if it's an individual stock. Mutual funds a little bit different, where they have distributions and they do stuff every year to kind of true up. But either way, with buying and holding, the idea is it could be more tax efficient. And the other part of buying and holding is you have a philosophy that you're not trying to time the market. You're not trying to buy when the market's down or individual stocks are down so you can then sell them at a high, because timing the market, in history shows this over and over and over again, and some of the best investors out there talk about how hard it is to time the market. When the market's going to go up or go down, or individual stocks go up or go down. You can evaluate and do fundamentals to buy certain things that, when they're particularly down, an individual thing, or maybe it's something that's good for the long term, and that's what a buy and hold person is looking for, is the long term. But you're not doing like constant trading when you're trying to time the market. When the market's down, you're buying, and when the market's up, you're selling, and you're constantly researching and doing a lot of that. Buy and hold is like holding, being passive, and letting compounding and letting all these things, time work to your advantage so you can, be very successful. The disadvantages of buy and hold is you might miss out on opportunities. Maybe something's way down and you'd rather sell something so you could buy something else. You can do that with buy and hold, but the idea is you're buying and holding for long periods of time. So you might miss out on some opportunities. And you also, buy and hold, you might be reluctant to sell poor performers quickly enough. Sometimes with a buy and hold investor, they'll buy and hold it and they'll just keep holding and holding and holding. And if something happens with an individual stock, let's say, where it's really going bankrupt or getting crushed or whatever, maybe it is time to get out. But a buy and hold person might be a little bit more reluctant to do that because they bought with the idea of holding for a long period of time, and they're maybe hoping that that will recover. So even buy and hold investors have to bite the bullet sometimes and liquidate on things as if something turns bad for a mutual fund or an individual stock. You might buy, let's say, an actively managed mutual fund because you like that fund manager and you think they're doing a terrific job. But once that person maybe leaves the company or retires, you can't keep holding it. And you've got to really look closely at that and say, maybe now's the time to sell that fund because we have a new person coming in. Part of the evaluation of it, or an individual stock, the same thing. So buy and hold is about holding and holding for a long time to let compounding and tax efficiency and all that and reducing fees work for you. The other extreme is actively trading. We're not buying and holding. The idea is that you're making lots of changes. You're looking for these new opportunities. It doesn't necessarily mean you're trading constantly or daily. There's something called day trading where they're basically trading hourly in some cases. But it's something that with regular active trading, you're looking to trade and sell frequently. You've got to be more engaged with the market, understanding what's going on, understand the positions that you hold as far as individual stocks or mutual funds, and really stay on top of that with active trading. And so you can take advantage of new opportunities that you might see coming around. And then you can sell those losers, real quickly. That's an advantage. That's another advantage. You can sell those losers really, really quickly. And if a winner has a quick run up, you can get out fast too and capture that income, capture that gain before it comes back down is the idea too. So you can sell losers, capture gains on winners, and you can reallocate too, particularly faster in a volatile market where stocks going up and down all over the place. Maybe a sector, healthcare's gone way up, you can sell that and you can buy that energy sector that's down, or vice versa, or those individual stocks. So you're actively more engaged in trading. And that's the thing, you're not buying and holding and forgetting it, you're actively trading, you're actively involved all the time. And that's part of the disadvantages to it is you need more time devoted to your investing. So if you have a lot of time to that and you like trading and you want to do some of that, go ahead. Just understand to do it well, it takes a lot more time. And it is very difficult to time the market. I'm not going to say to anybody that you can time the market. Nobody, the experts are saying that you can't time the market, but you can have buying and selling opportunities. But the idea is you're going to need more time devoted to investing to really be on top of it. You're going to experience, with the disadvantages, is increased taxes, increased fees. So your buying and selling has to outperform that. That's like when we learn about mutual funds, how index funds do well with very low turnover, very low buying and selling, so they have lower fees, lower active managed people managing it, so lower fees because they don't have somebody investing the time in it. Same thing as think of yourself as a mutual fund, but now you're investing your time to manage that fund, your investments, but also you're incurring taxes and fees with all those changes you make. So you need to outperform those extra fees that you'll incur. And really, investing overall really rewards patience and compounding, especially over the long term, where in active trading, is a little bit disadvantaged. It's a little bit less patient with that. And active investing will typically underperform in the long term. I mean, we see that in the experts. I mean, you see these experts, high-paid people in mutual funds. They run these big mutual funds with millions and millions and millions of dollars, and they can't outperform their index, right? So few outperform their index. How can a question to ask yourself, how can I, as the individual investor, how can I do better than those experts who can't outperform the index or outperform a mutual fund? Now, how am I going to do that with active trading? So it's something to think about when you're thinking about active trading. For myself, just to share a little bit, I'm a big believer in buy and hold. I will say that. I like to hold things, hold them for long periods of time. I'm a big believer in buy and hold. I try to make sure I sell if something's going wrong or something changes, because I buy and hold with the idea that a mutual fund or a company is going in a certain direction, but if all of a sudden they change, they make a change from their business strategy or a change in leadership, I'll change too. So I'm not locked into that buy and hold. And so I have a little bit of active trader in me, certainly too, more than a little active trader in me. And also I like to buy and sell individual stocks too, more so from fun and more so also from trying to get that little bit extra performance by concentrating maybe a few stocks as opposed to trying to build my whole portfolio and actively managing all the time. I got a lot of other stuff going on in my life with family, friends, making videos like this. So I can't be all my time being an investor. So I like buy and hold. I think it proves itself over time. It has served me very well. And a little active trading is fun on the side too as well. So think about yourself and your own personality and the time you have and your education and completing this course and other courses or readings to see if you want to be more of an active trader or maybe of the buy and hold. But those are the extremes, and then within those extremes, there's lots of different strategies and tactics you can use to get the best out of your investments.